For more on his reaction, let's bring in Derek Burleton. He is Vice President and Deputy Chief Economist at TD Bank. Derek, thanks so much for joining us this afternoon.
My pleasure.
So what did you make in the shift in language from the Bank of Canada today? Because it did remove that statement from, or that sentence rather, from its statement talking about its willingness to do more to raise interest rates further, essentially, in order to get inflation down. And like we just played there, the suggestion that the conversation is more about how long do we stay at these levels rather than how much higher do we go?
Yeah, very similar to the Fed. They seem to be following the Fed's playbook, albeit the Fed was on this a number of months ago, which does point to Canada's inflation, especially the core measure of inflation, holding up a little higher, showing more stubbornness than we've seen south of the border, which has really been quite surprising given that the U.S. economy has been outperforming on the spending side. But very Fed-like, very modest step towards the eventuality of rate cuts, albeit very non-committal, as the clip just indicated. So I think forecasters are taking a bit of a stab in the dark regarding timing. Still going to be a lot of debate on when that first rate cut's going to be.
Yeah, and I did think it was interesting in response to one of the questions in the Q&A. He said that it's important that we don't give Canadians a false sense of precision by giving them a timeline here as to when they could expect to see rates coming down. And I wonder if you think that is the Bank of Canada reflecting on having said things like rates are going to stay low for a long time, and then that wasn't the case, thinking about maybe learning from those moments and not wanting to map things out for Canadians in this way? Or does it really come down to just the fact that they don't want Canadians or markets to get ahead of these rate cuts actually happening?
Yeah, absolutely. I think there's just so much uncertainty regarding the inflation outlook, and they've been burned before. I mean, as recently as last year when they went to pause, that reignited some of the housing pressures, some of the inflation pressures, and then they ended up having to go back in hiking mode. Clearly, they want to avoid that this time. So, hence the very general tone of their statements. It is interesting when you look at their growth outlook and compare it to ours. They are very bullish on 2025 growth, which suggests to me that, given the way we run forecast models, and forecasters run generally the same type of equations, albeit there are differences, they do build in some significant cuts into their forecast to achieve that. So, they most likely are hoping to see rates fall to ensure that the economy remains in that soft landing, but boy, they're going to face a very challenging public communications, issues going forward, just given how sticky core inflation is remaining.
Yeah, do you think that is where they see the pickup in economic activity coming from, even just later this year, Derek? If they do start to cut, that will be one of the reasons that sort of helps lift the economy a bit?
Yeah, I do. I mean, their U.S. forecast is also more bullish than the street. They really ratchet up U.S. view. They noted financial conditions, which is interesting, recent financial conditions as being a driver of improving growth prospects in the second half of this year and into next year. Now, the question is that those financial conditions, or i.e. lower bond yields, are driven on rate cut expectations. And the markets are still building in at least 100 basis points in rate cuts by the Bank of Canada, even more by the Fed this year alone. So unless the Bank of Canada falls through with that, you're going to get financial conditions tightening, and then all bets are off on next year. So it's a very interesting dynamic here where inflation's still too high, and just the big risk that it doesn't come down as much, just given that shelter is becoming that big driver, and that's an area has very little direct influence on, given it's due to structural shortages and the like. But how it gets inflation down to a level that it can begin cutting rates, but significant rate cuts to keep their forecast on track.
What do you think are some of the biggest concerns right now? Because the past couple of years have been sort of this, expect the unexpected. So, I mean, we're thinking that there are going to be interest rate cuts later this year, and the Bank of Canada has this, expectation for inflation to be coming down in this way to get to around its target by 2025. But what would be some of the issues that could really derail, that trajectory, do you think?
Yeah, I think the big thing is core inflation. I think the one thing I found interesting is I looked at the statement and it seemed more dovish, and then I listened to Macklem, and he was more hawkish. I think just his focus on overall core inflation, and we've been doing a bit of communications work ourselves and releasing reports that argues that you take away that shelter, under the surface you are seeing some progress on disinflation. And this is something they're going to really have to give focus to. Didn't see a lot of that today, again, just given a cautious Bank of Canada governor and a cautious Bank of Canada. But I think that remains their biggest risk, is that if they don't pivot away from some of these overall core, and there are four they cited today. I mean, it's not just one or two measures of core inflation. They got about four. So it suggests that they don't even have 100%, focus on what they're looking at, that they could really be putting themselves between a rock and a hard place. So I see the biggest risk remaining. Rates don't come down from these current elevated levels. And then there are obviously all these other risks where rates could come down, but for the wrong reasons. International financial uncertainty. We got a lot of elections upcoming this year. We've got Middle East tensions, a lot of potential financial worries that could cause rates to come down, but not for the reason that it's just inflation coming down in kind of a soft landing scenario.
So when you're looking ahead just to this year, Derek, and thinking about when those interest rate cuts could start, I know, like you said, you're just trying to, it's a difficult position for forecasters to be in right now, especially with the Bank of Canada not wanting to circle the date either. But when are you thinking that the cuts could start, and how many do you think we could expect this year?
Yeah, I think a reasonable baseline is still sometime in the second calendar quarter of 2024. Still is several months away, particularly to say a June rate decision where they could pivot. And we know the Bank of Canada can move fast. They could use a speech. They could use the March statement to pivot, or even April. Still also think April's not on the table. So we have formally had April as that first cut, thinking after today that maybe June becomes more likely. But if they don't pivot, as mentioned, we may be waiting, and shelter does not look like it's slowing. It's such an important driver. If they don't start pivoting to some of the progress we're seeing elsewhere in goods, core goods and the like, that it could be a second half story. So yeah, that's our baseline now, with some of the balance of risk towards later move.
Okay.